Good afternoon, everybody. This is Jeffrey Scott. This is August 23rd, 2015, and welcome to this week's Top-Down Review. It is approximately 1:15 p.m., so as always, when I do it early, futures are not out, and this is probably one day when those futures will be even more important than normal. I've entitled this, When Support Becomes Resistance, Danger Follows. We saw that this week, and the question is this the beginning of the end of the bull run, or is this the end of the beginning of the bear market? So, don't know. Let's take a look at things and let's see what we see. As always, contact me through hgsidoc@gmail.com. So, time will tell whether we've entered a bear market. Your number one job is to protect your nest egg and live to fight again. Missing the beginning of a new bull or a new bull move is depressing. Not having any assets left to participate in the next bull is fatal. Let the charts guide you, not any video, including my videos, or any talking head on TV. You need to make decisions for yourself. You need to be watching the market. And we may see all kinds of fun and exciting happenings in the next couple of days. Be prepared. Have a game plan. Don't make a move until you see what move your opponent or the market is making. Disclaimer, as always, these are for educational purposes only. I have a lot of fun doing them, but remember, I'm a doctor, not a broker. I am not licensed to take your money, do anything with your money. I am not affiliated with any software vendor or trading company. The tools demonstrated are those that I use in my daily trading. Every tool I have at some point paid for fully. Trading involves risk. You and you alone are solely responsible for any investment decisions you make, and assume you will lose money. Lots of people have influenced me. I think the circle for me is I started with Can Slim, which is O'Neill, a great book to start with. I had my Can Slim taken to another level through Morales and Katcher, his disciples, and then Woodward and Brown taught me how to take it into HGSI and make money with it. And then the end of my cycle or circle is John Person, whose great tools and education helped me not only understand market context, top-down investing, sector, group, industry rotation, things that I've learned with HGSI and Can Slim, but when to take the trade, when to get out, and how to manage it. And that marriage of the two, Can Slim, which is a great foundation, and John's work of when to actually pull the trigger in and out and what to do with the trade, have really made me a better trader. Other key things here are Alexander Elder, three great books, as are John's books are great, Van Tharp, Position Size and Money Management, Comparative Relative Strength with Thomas Dorsey, and George Lee, as you see down there. I have a lot of programs. I try to remember to kill my desktop so I don't distract you. But I need a real-time trading platform, whether it's TradeStation or Thinkorswim. There's pros and cons of both. I prefer TradeStation. But that doesn't say that there's not cons or discussion there. Genesis is a wonderful platform for charting that I use as well. I don't push it because it's expensive and requires perhaps additional data feeds. For analysis, both end of day and also as delayed intraday, I love HGSI and EdgeRater. You'll see how I use them in the next 10-20 minutes. I do a lot of different seasonality trades, and there are a number of websites that I like. So here's what we ended up with on Friday, and I ask you to show me the strength. There really isn't any. Twitter was up a little bit on the day. That's probably notable. CZR must not be going bankrupt or must have worked out a deal with their creditors because they were up 16%. The Macau exposed casinos were down 3 to 4%. Transports, everything was down. Airlines, trucks, FedEx, UPS. Gold, for the most part, was down. GG was up less than 1%. AEM, which had a good week. I think also, let's see where AEM was. I can't do it on this chart. We'll talk about AEM later. Biotech mostly down, is mostly healthcare. Most of the utilities were down. Retail got hammered. Consumer staples, discretionary bad. For the most part, semiconductors and technology were weak. And if you really look at it, this was a market where it's hard to say there was strength here. So Friday was a tough day. The question is, what does Monday bring? If you look at the major markets, you see a breakdown, and this is on a daily chart. You could see the S&Ps had three. This is the futures big down days. More concerning is the S&P, the NASDAQ 100, the Russell, and the Dow all closed much closer to their bottoms than they did to their top. The Russell came off the bottom a little bit more than the others. You can't necessarily see it very well here, but you can see that little green bar. The VIX closed at its high. There's our VIX spike. My buddy George Lee loves VIX spikes because that's when he gets ready to buy. As soon as I know that this VIX has peaked and is heading down, that's when I get excited. I don't know if it's done going up. I'll be watching that. And you can see the US dollar has pulled back to the 50, to the 200-day moving average. The part that I find most fascinating is that we have blown through support across the board. And if you look at the Russell, which dropped through the 200-day maybe 2 weeks ago, you can see, going to my tagline for this week, that support here became resistance. And we may expect to see a bounce this week. I certainly do. We'll talk about timing before we get done. But will we get back above this 200-day moving average remains to be seen. So probably a bounce to happen, timing to be determined, not necessarily the beginning of a new bull run, and time to get back in. Part of my concern is these are now 15 or 5-minute charts, and you could see, except for the Russell that had peaked, it's dropped back here earlier in the day. All these indices finished right on the low of the day on the 5-minute bar, the VIX at the high, and also the low of the day on the dollar. So we weren't seeing at the end of Friday any evidence that the sell-off was going to abate. And then it doesn't matter what index, these are E-minis, NASDAQs, Russells, Dow, and the NYSE, which is an index, not a future. The others are futures. And we start with 5-minute bars, daily bars, and weekly bars. And the little orange triangle is a person's sell signal. And you could see we're in a sell mode on every one of these on each of the time frames. Now, I meant to put the cross here where my head is right here. That's about 2:15 on Friday. And it's funny, I had gotten a call from John, and we talked about the market looked like maybe it was going to hold here, and that maybe we should think about lightening up some of our shorts. Talked about it, and I think, and it was pretty clear right away, a couple bars later, when you failed to get above the pivot moving average and had another low close doji pop in here, that this market wasn't done, and it sold off the rest of the day. A couple of other supporting or contradicting things as we go through. Interest rates failed to hold. Since I'm building a new house, and I'll probably take a bridge loan in between buying and selling my old one, I'm thrilled because they told me that the rates on a jumbo are like 30-day LIBOR is like 17, 16, plus a little bit on top of that for my rates. So the low interest rates are great. So if you're building a house, if you had interest-bearing instruments like REITs, MLPs, utilities, dividend payers, low rates might be great. The problem is when low rates are a sign of an economy that's in question, both nationally and worldwide. And I think, if anything, the fact that our rates were down 1.4% this week are really sending a couple messages. One, it's to Janet, which is might not be the right time to raise rates as the economy is slowing. But it also tells me that maybe the economy worldwide is a problem. Obviously, we're not back to the 2015 lows, which was 1.65%. We're a little bit over 2% right now. But I think rates are telling us a story of fear and perhaps even deflation, which would follow what's been happening with the commodities in the marketplace. I like Lowry Research a lot, and I pay a lot of attention to this buying and selling pressure. And they gave me permission, I'm a subscriber, to show things on my webinars. Obviously, I'm not going to reveal everything that they do because I pay a lot of money for it, and maybe you should pay some as well. They have a great website and great tools, world-class economist. But I can go back and I'm going to talk about, are we going through 2014 or 2011 here? And I'm concerned because 2011 October was a much more robust pullback in the market. 2014 is kind of where we are right now. And again, I'll show you evidence of that later. But you could see in 2014, the buying and selling pressure started to come together. They never crossed. We've crossed over where selling pressure is exceeding buying pressure as the market continues down. The other thing I just wanted to point out is that we've broken below support, moving average support, on the advanced decliners on the S&P 500, the NASDAQ, and both the overall NYSE and the operating company. My buddy John Person talks a lot about how the NYSE is a very large basket of some things that may be, I don't want to say less important, but they're not all American. You have a lot of international stocks, a lot of dividend, bond funds, and it's a real mixed bag. So one thing that they've done over at Lowry is they've actually separated out those companies that are actually businesses that are operating, and you could see the operating NYSE is actually rolled over even more so than the overall NYSE. To me, those are bearish on both of these sides. How about the AD line here, looking at like a stock, and you could see that the AD line led before price, but price has caught up. But if this was a stock, you'd want to short it as it's dropped below the 50-day moving average and has failed to get back above it. You also had a death cross. This is a weekly on the left, and on the daily AD line, you have the death cross of the 50 crossing below the 200. And again, although price held up for a while, it's now caught up, and that divergence did lead to a price pullback. And again, is this a stock that you want to be buying if that AD line was a stock? And the answer is maybe, maybe not yet. So we'll have to see where it goes. And then looking at participation, and this is in the S&P 500, of what percent of the stocks in the S&P 500 are trading above their 200-day moving average. And you could see we're at about 25% here, and we're kind of at the same level as we were in October 2014. Here's where we got to in 2011, about 8 to 10%. So are we going to bounce here and act like 2014 and start to recover, or do we have some more downside to come? And I'm concerned about both these dates, October of 11, October of 14, and I'm going to be learning more about those as this week goes as I try and understand. I do have some trendline support that we broke through here as well. Stocks above the 40-day SMA, and again, here we are up here at 18%. We're not quite down to the October 2014, and we have a little ways to go to the October 2011. We're also only in August, and I heard several people, and I would agree, that this seems to be a little early for a market swoon, so maybe we get another run back up to that 200-day moving average before the ultimate pullback. Now, Ian brought us the canaries, and he brought us the canaries because we thought that the canaries might be a good indicator back when they were hot, 3-4 years ago, as when the markets would roll over. And I think he called them canaries because of the saying canaries in the coal mine. Well, our canaries in the coal mine, or you could take a subset of the canaries thing that Kramer likes, they gave it up this week. And you could see on Tuesday there was a bit of a spinning top here, and I don't think that's a head and shoulder or anything like that, but is this your head and a left shoulder and a right shoulder? And we took through, but whatever we did, we have a high volume breakdown. Look at the volume on Friday. Yes, there's options expiration. We had a weekly and a daily bongo fire sell. I think that the canaries are singing that this market is rolled over, and they're not leading me up, they're leading me down. So from stockcharts.com, these are all free charts there. I pay for it, but these are some of the free ones. Sector ETF performance going back since the beginning of the year, you could see that energy is down the biggest and healthcare is up the most. Healthcare and cyclicals up close to 10, energy down about 1,500, materials and industrials also lagging. If we look at the last week and the last month, we could see that the big story here is utilities are up 11.85 in the last month versus 0.82 for the year, and that energy continues to lead to the downside. Healthcare has given up a lot. They've been big leaders, up 9.3, barely up over the last 5 days or 1 month. If you go from the peak of the S&P 500, which was on May 20th, 2015, and this is why, I said, is this, the end of the beginning of the bear, and not the end of the bear, and has the bear already started? I think it's a lot easier to know that in retrospect, but if you look at since the May 20th time frame, you could see the Dow's down nearly 10%, the NYSE 9.8, but all the industries are down, indexes are down over 7%. If I look at the short-term index performance for the week, the NASDAQ down 7.5% in a single week. Since high growth stocks are predominantly, are often NASDAQ growth stocks, we might expect to see growth got punished this week. On the month, the NASDAQ is down nearly 10%. Again, I think when we do get into a bear, we'll look back and we'll say it started back on XYZ date. A 10% move in the NASDAQ in a single month and a 7.5% in a single week is a big move. So my thoughts, we finished at the low of the day on Friday, so selling may continue. Expect a bounce during the week, but that bounce, I don't know when, and I'm concerned that it's not the beginning of a new bull, but probably a test of resistance and likely to be short-lived. Speaking of resistance, I think we're going to see a case of the old adage, old support likely acts as resistance. Key drivers, I'll be watching my futures tonight after dinner to see what happens in China, and then I'll be checking them. Being a man of age, that means I'll have a few opportunities between 10 o'clock and 6:30 in the morning, or when I wake up to use the bathroom. I'll probably sneak in and look at my China numbers, because I think that's really going to tell us what happens. If China goes proactively and does a major ease tonight, then the Chinese market may lead us higher. So if the market opens down 4 or 5%, and then they come in with support and the market ends up closer to normal, even if it's down, then I expect most of the damage in the spiders, et cetera, to happen overnight. If the Chinese market trades down and either the actions taken by the government are inadequate or don't happen, and the market finishes lower or as low at the end as where it opened, I don't think we bounce right away on Monday. I also expect to see Fed heads this week talking down the rate hike, trying to prop this market as well. Bottom line is, even if we do get a bounce, it's not a time to go all in. Longer term, we're in topping. Slowly, worldwide economy, full employment in the U.S. puts our Fed in a hot seat. And again, go back and look at October 2011 and October 2014. Not all bear markets, let me back up, not all corrections end in bear markets. Not all bear markets are similar to the bear market of 2007 and 8. We could have 10, 15, 18% pullback and set us up for a great rally into the election. But right now, let's wait and see what happens. Risk management remains the name of the game. So stock patterns are cyclical, all right? I no longer am thinking we're in the yellow box. The question is, are we in the red box, or did that 10% drop over the last month put me back down into the green box? And by the way, the green box on the left and the right is really at the same period of time. The difference is how long that period of after you sell off before you start to go up is. So if we are in that red box, defense, defense, defense. If we're in the green box, you have plenty of time before you worry about going all in. I don't think this market is ready to go back to the moon. It could. We could resume the uptrend in the bull. I'm not feeling it. But that's not, like I said, this is a video. You watch your own charts. You make your own decisions. So I'll talk about exactly what I did last week, but what have I been telling you? Raising cash, smaller position, selling premium. That's been my mantra. After the market started rolling, I started looking over here and trying to figure which one on this right-hand side could I do to start both to take advantage of the market pullback, but also to protect whatever long positions I have. So as the week went on, I sold anything that wasn't working. I don't care if it was a long-term or short-term holding. I'll pay plenty of taxes happily. But I sold a lot last week and raised a lot of cash. I then looked at protecting what was left on my long-term holdings. So I have a core group of stocks that you always want to have those stocks that are up a couple 100%. And the way you get them is not to swing trade them. The way you get them is you buy them and you just keep holding. Now, I've learned with stocks like United Rentals that at some point, holding doesn't make sense anymore. And so now I get a little bit scared at times of big market entropy. So there are a number of stocks that I bought coming out of the 2009 market disaster that I still hold, or the 2007-8 bought in March of 2009. Those stocks, I'm not ready to give them up, the ones that are left. Those stocks include things like Bank of America, BX, which is pays a fat dividend from Blackstone Corporation, Gilead, Delta Airlines, and let's see what else is left on that list that I haven't sold this week. And frankly, that's it. The rest of my long-term holdings, including my Celgene position, which I got put away a couple weeks ago at 130, are gone. So if I just called your name, Horizon Pharmaceuticals would be another, but it's more an interim based, but with a big return. If I just called your name, then assume I've got puts on you. And I bought these puts before the VIX spiked, so puts were really cheap. In fact, I've got puts on more positions as well that are shorter term. Buying puts when they're cheap is not a bad thing to do ever. I bought insurance. So by insurance, I meant I wanted to participate in the downside if it came, but I also wanted to protect anything that was uncovered on my longs. So I had an OEX put spread. I had a 910 to 890. I never thought 890 would get taken out. It did. So I did fine, but I could have done better if it was single-ended. I had Q puts. Again, I had a nice spread that got taken out because they fell more than I thought. I still have some puts on. I have SDS, TZA, and VXX and BIS calls. All of them at the end of the day Friday, I covered them with the spread. So if the market bounces on the open, I'll at least get back some of the what I lose on the long ones by making up on the shorts. And then I went offensive. and I hope I don't get punished for holding these, but I have Jazz, Tesla, and Ryder are some of my bigger names that I've got short positions as well. Some out and out short on stock and some on puts. I may get hurt on Jazz. That one, if the market gaps open big, I'll get hurt. I'm not in the same thing with Tesla, but we'll see. I think that if the market gaps open big, I'll make more money on my longs. I won't be too upset about the shorts. Know your news and your earnings dates. Here are a list of some of the important releases to come out this week. As I look at it, there's a lot of housing related stuff. We got some initial claims on the 27th, continuing claims. We got second estimate of GDP for quarter 2. And then we've got some energy inventories and Michigan sentiment. Again, I expect this week to see the Fed coming out and defending that they're going to be data-driven and not committed, no choice to raise rates this September. If I look at the earnings, obviously a quiet week, unless, of course, you own, and there's a number of things here, ANF, AVGO, hammered, Burlington Industries, some solar stocks, some gun stocks, some technology stocks, big lots. If you own one of these, you need to know when your earnings are. It's judgment call to hold stocks over earnings or not. It's bad judgment to not know that earnings are coming on one of your stocks. All right, chart of the week. I started doing this a couple of weeks. Obviously, last week was a bad week to tell you what stocks to go long on when the market was down 7%. That said, I didn't do so badly. So far, the picks that we've done, AMSG and Cone, are still way up since we bought them, even with the market tanking. Although I would hope that if anybody was silly enough to take trades just because I'm suggesting them, that you're also putting the stops in that I suggested and trailing up your stops after the stock moves. These are for fun and education. They're not recommendations. And sort of a kidding aside to somebody who emailed me, I always appreciate his emails, not to be bought in the pre-market on Monday just because I'm pretty convinced these are good charts. I don't warrant any expectation of return. If I say I'm taking options, that's even higher risk. If I bring a trade up, I'm going to take it. If it hits just because I brought it up here and I think it's good for education. If you look at these trades I define, if the market trades down, they never get filled. I'm not doing this to provide stock picks. I'm not doing it to show off. I'm showing to show you how I trade, how I choose specific stocks and strategies, and where I would plan on taking profits or placing stops. And I do this before the market opens, not telling you what I did retrospectively. So there were 3 last week. The fact that there were 3, CSFL, CSL, and ARE, should tell you that I wasn't in love with any one stock, therefore I had 3. If you've been following me for any length of time, you know that I'm a sucker for this pattern. I'm a sucker for a stock that's been in a cleared uptrend for some time. I love it when they've started to go sideways and wait for the 50-day moving average to catch up. I love it even more when they have some momentum. These are kahunas, mobile breakout from a squeeze, and everything up top starting to turn green, coming into the stock at support. This is could have been a pullback to the 50 with a kahuna, or a stock close to PSA reversal on my HGSI scans. And I suspect it may have also been a PPS buy, and we'll look at in the next second on John's work. So this was CSFL. My concern that I brought up was it's a bank and interest rates were coming down, and that will be bad for banks. So this was my favorite one. Here's what we did. So this orange candle was a high close doji, which occurred on Friday last week with a person buy signal on the daily. So that's kind of what drove me to it. I said to buy it if it takes out 1430, stop at 1359, risking about 5%. Trade filled Monday at 14.30, closed the week at 14.06. It never hit my stop, and I'm long in this position right now. At this point, I will probably leave my stop where it's at and see what happens on Monday to the market. That is not a great trade, except when you consider the fact that the S&P was down 5.77% on the week, and this was down 0.78. And if you look at the three other stocks that I introduced, Center State, ARE, and Carlisle, Carlisle got hurt the most. The one that I took was CSFL, but they all outperformed the market. Tonight, introductory comments are done. Let's go look at the market, some top-down analysis. Not a lot of bullish charts to look at. Do a bottoms-up analysis, and then my pick. Oh my God, am I going to take the risk of the chart of the week? Upcoming live events, October 16th through 18th, the Greg Mills meeting, Orange County, headlined by George Lee. I'll be speaking as, hopefully, will be Gil Morales. And then if he is available to come from a health perspective, a wonderful trader, David McMullen, really good at protecting your portfolio. The PV meeting, Ron and Ian. Ian is up and running and looking forward to the meeting. And they actually have a discount for early adopters who sign up before the end of this month, I believe. Certainly $100 is $100. You should probably take advantage of that. And then for those that are going to be in this area, the following week, October 31st and November 2nd, John Persons has his fall meeting, and I'll be speaking at both the October 16th George Mills and October 31st John Person event. See you in Florida next year at my training in February, and perhaps sooner at one of John's events. All right. I do the same analysis every week. I'm going to do it again right now. Start with my trade station, and let's take a look at this view, which is a combination of elder and person, and I use it as a simple market timing. Not Fred Richards, single market timing, which has to do with a crossover, but I mean simple as in it's easy, and it gives me an idea of what's working or not working in the market. There are probably 3 or 4 things that I'm looking at here. The magenta and the cyan or red and blue dots are persons buy and sell signals. The bar color, if it's green, it's okay to be long or buying new things. If it's red, it's okay to be shorting new things. Both green and red, it's also okay to be holding. If it's green, I shouldn't be shorting. If it's red, I got to be careful. I shouldn't be buying. If it's blue, it's neutral. I look at that factor on daily, weekly, and monthly. In periods of very much oversoldness, of which we're going to see on a couple of the indexes, I might see green dots at the end of a price bar and overboughtness, red dots at the end of a price bar. And those are hints that we're seeing some element of MACD divergence. Doesn't mean MACD divergence, but it means I'm supposed to look at it to see if I have any MACD divergence. I also look at the high jump bar under normal circumstances. That's not an issue right now. Let's start with the NASDAQ. What do we notice on the NASDAQ? We're in a person sell, an elder sell on daily, weekly, and monthly. We are the lowest low that we've been in quite some time. And as I said, the date I'm looking at is going to be October 2014 as one of the times that I'm concerned about. This is it here. And then the other date is October 2011. Those are some of the bigger corrections that we've had in this bull market. And I think as long as we stay in those areas, that perhaps this bull is still on. But I am concerned, as I've said several times, that this could be the beginning of the bear, and we'll see over time. So NASDAQ looks unattractive to go long. I need to see some damage control. Now, what would good look like? This is what good would look like. Let's go back to that October. This is the kind of day that I'm going to look for to tell me that it's okay to go in. Here's a day where we open lower and closed up near the high of the prior day. All right. Here's a candle where we opened lower, traded low, and had a reversal, kind of a hammer. That's what I want to see. Those are the types of things that I'm looking for to tell me that we've had a reversal. And I'll be watching for those even before the open tomorrow. NASDAQ, obviously, don't buy. Dow, red on a sell signal, monthly and weekly, a lot of damage to fix. NASDAQ 100 gave up the ghost this week in big time. Deep pullback right across the board in a sell signal. Semiconductors. See these green dots? These are when you start to think about MACD divergence and evidence that perhaps we're getting near the end of a decline. It doesn't always matter. As you can see, we got lower here. But we're in a sell signal on all of our indicators. Cash S&P, sell signal. Spiders better look like the S&P. They do. NQ100s look like the NASDAQ. The NQ100s got hammered this week. I said the Russells came off their lows more than others. You can see the MACD divergence signal here. But you can still see red and on a sell signal. IDUM, if you don't have the Russell futures, similar pattern. Now notice you can really see there are a lot of stocks that started looking like this, and some were even green, where they finished higher than where they opened. But these long legs, really a lot of market indecision at the bottom on the Russell. The diamonds closed at the bottom, and the Qs also closing at their bottom. So pretty clear that this was a really tough market this week, and everything looks ugly. Sector-wise, materials on a sell signal. Energy, you know it's on a sell signal. Financials, big move down. I think this all came out with the concern about interest rates not going up. Industrials, big down. XLK, tech, down. XLP, staples. XLU, utilities, the lone bright star so far. On a person sell signal, though. XLV, even healthcare beaten down on a sell signal. And lastly, XLY, consumer discretionary. Now, let me go back to the S&P will have a similar pattern. We've had 1, 2, 3 big down days in a row. One would expect that the market doesn't fall every day forever, that we're going to see bounces back. We could see the bounce depending on China's action tonight, Monday, Tuesday, Wednesday. It will be almost shocking, surprising if we don't see a bounce. But let the bounce happen before you start to go long. Let the bounce dictate, because everything I've shown you said it's not time to go long. Let the market lead you. Don't you lead the market. I mentioned before that not a good week for growth. So there's 3 that were positive. That means there's about 100 that were negative. Most importantly, IBD 50, HGS 100 were down about 6.5%. Best of Woodward and Brown were down 7%. The S&P was down 5.77. My buy list was down 5. There's nothing good. The top Vector Vest were down 5. I can't say anything positive about any performance and growth this week. Of course, the Tim Higgett filter, which I think just had Sucampo, was the only one that was in it, was actually up 6%. But, most of these heavily to the downside, 80s and 90% losers. In fact, look at the IBD 50, and you wonder why your accounts were down. 0 for 50, down an average of 6.21%. And this is a highly maintained list from one of the largest trading, teaching, and technology companies out there, and they were 0 for 50 at minus 6.2. Don't kill yourself just because you had a bad week. Now, you would think maybe we had a Hindenburg this week. Think again. To have a Hindenburg, you've got to have your new highs and new lows above 2.2%, both of them, okay? And if you look at where we are right here, and then I'll show you where it's not all exciting, it's all happy. We had 0 new highs on the NYSE. We had 588 new lows. So think about that. We've now hit the highest that I've seen in a long time. 18% new lows and 0% new highs. You can't get a Hindenburg unless you have 2% new highs. So now let's go back and let's go see what it looked like in November 2014, which is what we have over here. Should have gone to October 2014. Actually, I did. What I want to show you here is just the remaining of the last year to November 6th. And that is the biggest number in the last year of new lows on the NYSE. And I think that's telling a story. We haven't had a Hindenburg fire. We're so far down off our peaks and the number of new highs, we're not going to have one fire. So will this be a bear market that starts without a Hindi? Or do we have a run-up to generate some more Hindis before we fall? I think we have a run-up. There, I said it. But from where? Just want to show you 2007 into 2008. Obviously, this was the heart of the last bear. Here's a 20% new lows occurring January 9th, 2008. Here's a 31% new lows occurring January 22nd. What I wanted to show you was that you can have almost 0 new highs persist for months. So just because we're hitting these super low numbers of new highs doesn't mean that it's got to bounce from here. Speaking of bounces, here's our buckets. We're at 88% and about 42% below the lower Bollinger Band. Of course, in a bull market, one would expect a bounce within the next day or two. Question is, are we still in a bull market? Here's the last time we were up, and we did bounce. We were at 22 and 71. It's been since March that we've had 70% above the Bollinger Band. So we've been oversold, at least by this view, for quite some time. And we are really oversold right now. Now let me put this oversold into context. Let's look at October 2014. We're at 88 and 42. October 14, we were at 84 and 35. Here's what I put on the board, on the HGSI board. Going back to 1994, the number of stocks trading below the Bollinger Band is the 45th highest of a sample of 5018, which means there's only 0.1% of prior readings exceeded today. We also tied for 84th for the most stocks trading below the midline of the S&P 1500. Posted 10/1/2014. We're worse today than we were on this date. The market did not recover after this date. We still had a little bit more of damage to get over. So I guess, actually, this was the date I posted it, 90 and 37. And here we were 6 or 7 trading days later, which were still very oversold. So you can stay oversold for quite some period of time. This is my high road, as Ian likes to have pick 3 roads as we bounce from here. My middle road is we look like October 2014. And my lower road is we look like October of 2011, which was a little worse. I sure as heck hope that we don't pull off a 2008. This is what happened in 2008. We're not much different looking than we were October 3rd of 2008. 94%, and about 42% below the lower band. And I put this here to show you that we stayed in the toilet here and got progressively worse over the next 6 trading days. In both the October 1st of 2014 and October 3rd of 2008, we're not we will not sorry, I looked at an email. We looked at 2014, we looked at 2008, and that's what bad looks like. We've got to be careful here, and we are at risk that we're doing this again. But again, let the charts talk, not Jeff Scott. Markets, series of kahunas on Wednesday and Thursday. You could see our percent B change got less negative on Friday, but we are decisively in the lower half of the Bollinger Bands, and we're on sell signal on every index that we look at. Let me go to seasonality, which is sort of the one thing that really made me scratch my head. This is using historical performance now in Edge Rater, list of things. Let's look at the 1 month column. As you can see, there are a lot of stocks that have strong seasonality over the next month. And if I look over here and I just take a look at the strongest, and I look at some that actually have really good performance, you can see Acacia Research Group up 10 out of 12 years, 28%. Medivation, 10 out of 12, 18. Even Mankind, here's Lululemon that was setting up last week before the market rolled over, up 8 out of 8, 17%. United Continental, 9 out of 9, 14%. So there's a number of things here that might give you some ideas to look at if this market goes up. The interesting thing, here's the Qs to the long side, 8 out of 9 years, up 7%. So even though September is a tough market, August at this point is more of a favorable month, but you saw what all the indexes look like. And you could see the things that are leading to the downside are the short things. Ultra short Qs, 8 out of 9, minus 7%. Ultra short Dows, 9 out of 9 years to the downside, averaging 6%. Ultra short S&P, 8 out of 9, averaging 6. So the things that would say, the ones that do poorly over the next month are the inverses. So perhaps there's some reason to be excited here, and that what we're going to do is get a bounce soon. Let's go into HGSI. And let's go into T-View. And let's go into Major Markets Plus. And, you know, what kind of a great market is led by gold, silver, treasury bonds, and volatility in the utilities? That's not a bull market by any means. And this is the strength mostly on Friday, Monday to Friday, and then 3 weeks, highest to the more recent time. And you could see that our typical averages of NASDAQ, the NYC, the Dow, mid-caps, the S&P 100, 500, 1500, and Russell are all in the lower part. You could also see that over the last 5 days that we just had massive moves downside in many of these indexes, as we talked about in the beginning. Volatility up over 100%. It's funny, I had a bunch of VXX, but it didn't feel like a 100% move. Gold also staging a good week. Let's take a look at some of our favorite ones here. As we know, there were no kahunas on Friday, but there were kahunas earlier in the week. Let me introduce you to I won't say one of my favorite friends, and something that we don't see very often, and that is this maroon bar here, which is called the Phoenix. In fact, I had to go back quite some time to find the last period of time when I had 2 Phoenixes fire concurrently. In fact, I'm still going back looking for it. Still going back, and we'll see. I think we're going to go all the way back to 2011 before I have 2 days in a row with a Phoenix. There it is. Okay. Now, this may not look like much of a correction, so let me just tell you what we're looking at here. From the high on the first Phoenix to the low here, that was a 10% correction. Okay. That was not from an extended market either. That was the end of the corrective move. So let me get back to where we are today. Phoenixes are the follow-through date to the downside, discovered by Ian Woodward. At the end of a big pullback or downturn, Phoenixes could be over-exuberance. At the beginning, or irrational exuberance at the beginning, it's usually a sign to be concerned. I don't see a huge long-term downtrend. Maybe we got them firing irrationally because it moves so fast. I take heat-ins. Another one of my friends that you never want to see on a major index is the bingo sign here, which we haven't seen many of those on the indexes. We saw a couple here in October 2014. And these fire right before the end, or can fire before the end. But in a bear market, they continue to fire as you drop. And they're sort of the baby out with the bathwater days. So here's the S&P. Let's clean it up a little bit because I think it's now a different pattern. We are now in a downtrend in the S&P 500. Whoops, try that again. We have lower highs and lower lows. Okay. We've seen this in the Russell and the Dow. We have now, I think, potentially gone into a downtrend on the S&P 500. We are clearly oversold. And the question will be, what happens next? Now, do we, you know what, I can't take a snag at picture. Do we just run back up here to new highs? I doubt it. Do we run up here to this 200-day moving average, which will start sloping? And then just bounce around in here? Yeah, I think that's the most likely. Or do we just continue to fall? Those are the scenarios. I think that the least likely scenario is that we just turn around with a V bottom and take out new highs. I think the most likely scenario is the S&P eventually moves back up, but then this is going to be tough support. This 200 is held for years to get above that 200. Now, if I want to be optimistic, still in a long-term uptrend, but now I've got the 50-day weekly, which is pretty much the same as the 200-day that I'm going to have to be worried about. And again, what did 2011 look like? This was 2011, and from the high to the bottom, that was a 22% move. We're halfway there. All we need is another 10% down, and we look like 2011. So I'm cautious. Let's talk about Monday and how I'm going to behave. Wish I had something good for drawing. I must have, well. I'm going to put a line that's where we closed on Friday. That's where we opened on Friday. the most likely thing that's going to happen in my mind is that we bounce around in between those lines. That's not decisive to me. That's one thing that might happen. I'd say it's most likely. If the futures are horrible overnight, if China doesn't do something that fixes things, then we'll probably sell off at the open, and either Monday or turn around Tuesday or Wednesday, we will get a bottom, and we'll start to have a picture like this, like this, like this. This is the candle that I really want to see. This one right there with the nice bottoming tail. That'll tell me that we're done falling. And then when I take out that high, then I might want to go all in the market. All right, and as you see, here's another hammer after the big pullback. I'm expecting to see a reversal occur at this point. I just don't know when. So if the futures open up tonight, drop 200 points on the Dow, 20 on the S&P. China's down 400 points. Chinese government intervenes and the Chinese market closes higher than where it opened. Then I expect our futures to give me that hammer already before the market opens, and then I might want to be covering my shorts and playing to the upside. If the Chinese market opens down and there's no intervention and it continues to trade down, or it opens up and it trades down when there's not an intervention, then I expect our futures to continue down, and then I will play defensive until I see a bottoming formation, and then recognize that whether it occurs Monday, Tuesday, or Wednesday, we'll probably see a pretty ferocious rally. But first I got to get above the high of Friday, and then I have to, can I even get above the 200-day moving average? I doubt it. So let's see what the market gives us. I'm looking for a bounce. I'm looking for that bounce to not take out prior highs. And as far as I'm concerned, we're still in a downtrend. And there's somewhere in here is the right trend line that I would not expect us to get over on the bounce. Then again, I'm a doctor, not a broker, and that's just my opinion. Continuing on, and we're spending a lot of time on the market because, frankly, I'm not going out and telling you to buy a lot of individual stocks. The NASDAQ, similar pattern. Here's my Phoenixes, which are calculated in the NYSE, so you'll see them on everything. Here's my bingo, and here's my high volume sell-off. The Russell, higher on the list. Now, a little bit more interesting of a candle. You could see the Russell, and as I said, I talked to John about 2 o'clock about this. The Russell looked like it was trying to stage a comeback, and it failed. That might be the first one to lead us back. And lastly, the Dow looks like the S&P. If I look at the utilities, they pay interest, they're more defensive. They pull back Thursday and Friday, but they've been in a nice uptrend. So unlike everything else, an uptrend still persists, higher highs, for now higher lows. Transports had been moving back up, and they sort of gave it up at the end of last week, as you could see. So market still looks like trouble. I'm looking for clear-cut evidence of a bottom, albeit maybe a short-term bottom, that will tell me it's time to think about getting in. But I'm not going all in even at that point, and I'm going to recognize that this is probably a dead cat bounce after a huge sell-off, and I still expect lower lows. That's how I see it, for whatever that's worth. Other things of interest, the VIX. VIX spikes are times to buy. It looks like we've spiked. I'd like to see it come back a little bit so I know the spike is over. I'm not convinced that we're not going to see a higher spike. Here was a spike up to 33 in October of 2014. And I bet even 11 was even worse. Let's see. Here's 11 was up to 42. So this is a spike, but in the context of big spikes, it's not a giant spike. So is it done? And if I see a sell signal coming into that, or it looks like a coming back into its base, then I'll know it's okay to be long. Further evidence. The dollar, for such a strong economy versus the rest of the world, our dollar pulled back into the 200-day moving average. Now, I expect support to hold, but it did break through a little bit on Friday. For the dollar bulls, not a good thing. If the dollar is weak, then we should see strength in gold and silver. And you could see gold did okay. Now, the interesting thing was gold was up, but gold stocks were down, probably just related to the market itself having a tough time. And here's silver, similar picture. Still in downtrends, but showing some life. And then oil, just a steady drop to nowhere. All right. Now, let's go down the industry view, and you'll see how depressing it can get. Now, I don't know exactly what's affecting my my force 2 to the downside, and it's because it's only giving 2. So it may be that most of the move has already occurred, and the short-term movement off the bottom is less. I don't know. But if I take my major ETFs, for example, and I look at 2-day up, the ones that are working are VIX, gold, treasuries, and VIX. So VIX, futures, gold, and treasuries. If I look at what's not working, natural gas and silver, that's interesting. So gold doing better than silver. If I go down to the industry groups and I look at the 2-day, well, let's look at how many I have. I think I have 171, something like that, 173. If I look at 2-day force up, I only have one group that's moving up. If I expand that to 5 days, I have 2. If I look at 1 day to the downside, so big movers to the downside on Friday, were 2, and that's where I'm like scratching my head. But if I spread that out to 5 days, you could see the damage in the market where over the last 5 days, 85 of my 173 groups have been leading to the downside. So a couple of our past favorites on semis. Ambarella, I mean, double topped here at 126, at 128 or so. Will it come all the way back to the 200? Made a lot of money up here. Don't want to be in it down there. Intel Corp. Not a really good looking chart, is it? Looks kind of like the S&P. Looks a lot like the Qs. Micron. Qualcomm. Skyworks. Well, pretty clear that semiconductors, what were leaders are laggards. Diversified banks. I still have a position in Bank of America, but I've got puts on it, so I'm not too nervous. But Bank of America has dropped bad. I can't say anything else about it. It's just gotten hammered. And I think part of this is because of interest rates. Part of it is because of slowing economy. I think this is one of those places where rising rates are good for the company. Boy, our bank's weak. Bank of America looks horrible. I guess fundamentals don't matter. Look at the earnings coming into the stock. Citigroup, not as bad, but almost down to the 200. JP Morgan, heading to the 200. Wells Fargo, knifing below the 200. Big banks look horrible. Might be a place to see some bounces. Infrastructure software. I'm going to look at one I like and one to be concerned about. CyberArk. I've made a lot of money on this stock this year. I'm out of it, been out for a while. CyberArk actually looks okay on Friday. It dropped off but closed higher than where it opened. Still a big down day. I think I saw an IBD, 40 million, whatever it is, they got a massive number of shares that come out of a lockup on Monday. That could propel up market up because of liquidity or propel it down if people who have been waiting to get out now have a chance to get out. One to maybe nibble on, and this would be small nibbles because it's an expensive stock. Let's look at a weekly on Palo Alto. If this market bounces, this has been a big leader on the upside. It's had 1, 2, 3, 4 big down days in a row. Maybe Palo Alto Networks might be one of those rebound stocks that I'm going to put down on a shopping list if this market bounces. I don't buy any of these unless I see the market improve. Biotech, ugh. Gilead, one of the big losers, over 10% down on Friday. This is why you have puts. Down to its 200. If the market holds, still a great company. Nothing has changed. I think that, whether people had margin calls and they sold their expensive stocks, I'm putting this on my list to add to if the market holds here. Certainly ugly with a couple kahunas to the downside. Do I want to be making fresh shorts? I don't know. I want to see what the market does. Celgene, big down day on Friday. Made me happy to get my puts calling me away up here. Not the high, but I picked up most of that move. But you know what? As Dan Fitzpatrick said today in his video, I think it goes higher. I agree. There'll come a time when I want to get back into Celgene. Just not yet. Biogen. Is this a double bottom? Does it go from here? I don't know. These are broken. These are beat up. They're certainly laggards, not leaders. I didn't do that, did I? Specialty pharma. Let's look at Jazz. I'm short Jazz. I'll probably cover really quickly on Monday. I should have covered it on Friday. That was my mistake. I got short Jazz. I really was only short Jazz for 2 days. Actually, 1 day. It met my symbols when I looked at it Thursday night and said, this stock's going down. And I didn't think it was going to all happen in a single day. But we're down now to where we bounced before. That's why I need to worry about covering this. Jazz was down. May all your shorts drop 6% in 1 day or $11. This is going to bounce. We'll see how much of that $11 I have left before it bounces. Again, it's going to bounce if the market has gotten the signal from China that it's okay to bounce. But let's let it bounce and let the market give us the signals before we start taking away or changing our holdings. To the upside, not much. Computer hardware and storage. Dot Hill is a takeout, so we don't care about it anymore. Brocade was in a terrible downtrend, maybe putting in a bottom down here. It actually had a big gap up, mobile breakout, and a kahuna on Friday. Must have had earnings come out. Looks interesting, though. HP had good earnings, as did Net Appliance. So this is the only place of strength, and that's not a pretty chart. Here's HP, similar, big move up, but couldn't hold it. QLogic, all beaten down, not real attractive. And that's it to the upside. Now, personally, probably time for me to start putting together a list of stocks that I might want to be watching to give me ideas to get that if the market turns around. So these are not buy recommendations. It's just some thoughts that I have. Facebook. I have a huge position in Facebook. I have puts on my position. All right, so if Facebook starts to rebound, I'll have to decide whether or not I give up my puts. For my puts, the line in the sand is probably that 50-day moving average. If we don't break above that 50-day moving average, I'm going to keep my puts on. If I look at the weekly, I'm at the 50 weekly. So my downside target, hard for me to believe we're going to get all the way down here. Hard for me to believe. Just because I don't want to believe it doesn't mean it's not going to happen. So that 50-day moving average is at $80.91. Wouldn't it be nice if you could buy Facebook for $80.91? Well, let's not be pigs. We closed at 86.06. The low was at 85.61. Low here is 85.23. The low here is 83. So why don't you put yourself a little note that says, if Facebook trades down below 85, you might be interested in looking if the market snaps back. Let the market snap back. Don't jump. Netflix. If somebody told you you could buy Netflix at $100 a week ago, what would you have thought? You would have thought, not going to happen. 17-day moving average is at 98. I'm going to put myself a little message. It says, this is where we last broke out. Netflix trades down to 95. I want a signal, or 96. I want a signal to fire off that says, start looking to go long, especially if the market turns around. I'm not going to buy it if the market doesn't turn around. Amazon. Talk about ugly. I should go back to daily, shouldn't I? After a big gap up. Well, guess what? We've now filled the gap. Our 50-day moving average is at 481. Note to self, Amazon at 480. I want to be in. It's going to bounce. It's bounced off the 50 several times. Let's take a look at something else. Ulta, one of the picks from our June meeting. Broke out and had a nice little run. Pulled back to the 50. Last congestion was about 155, 152. Ulta, if it gets to 155, I want to start looking at it, especially if the market turns around. So the point of what I'm doing here is I'm looking at some of the stocks that have been big winners, and I'm trying to decide if they pull back and give me a gift, do I want to buy them? Apple, not a gift. Skyworks, not a gift. AVGO, looks like Skyworks, not a gift. Why are these not a gift? They've all broken down below the 200. GoPro was working, not working now. And I'd go through a list of the leaders looking for stocks potentially to put on a list for when this market turns. I'll tell you what else I'm going to do when this market turns. When this market turns, I am going to run an HGSI update. Let me show you what I'm talking about. I'm going to update and make sure I've got intraday data, and I'm going to do a full update as soon as I think the market has turned. And then I'm going to open up my warehouse view, and I'm going to take it, and I'm going to start to look at the force up and see which groups are moving up and which stocks within those groups are moving. And I'm going to go up into the Woodward and Brown groups, which were recently updated, August 18th. And I'm going to look for the group, oops, actually I want the filters, don't I? Yeah. Sorry about one of the views to the Woodward and Brown, 818. And I'm going to look for the intraday stuff. I thought I'm in the right one. Hold on a second. All right, well, I know know they're in here and they're probably right in front of my face. So where did we put, I'm sorry. I'm going to go up here to the intraday. And I'm going to start looking at various groups intraday. Price change up, stocks and groups, gaps up, price percent, high volume with a big move. And I'm going to start to do some of the intraday analysis and try and get an understanding of what stocks are moving at that point in time. And the nice thing about HGSI, I can do all of this analysis intraday. Unfortunately, with a 10 or 15 minute delay, but I'm still able intraday to see what's moving, what's not moving, and make some buy and sell decisions. Now, let's look at some charts of the things that I thought looked interesting, where they are. I'll comment on them, and then I'll give you my stock of the day. So, warehouse view. And believe me, I went through a lot of charts to come up with potential stocks to buy. This was it on my buy list. You'll notice that at the top, they're all ETFs to the downside. I do not know which way this market is going to go. I know that I've done well with my contra ETFs, so I'm going to look at a couple of those in a second. From stocks to go up, there's not a lot there. So first let me talk about the contras. If I think the Dow is going down, then I want to be looking at DOG or DXD. This is ultra short DXD, and you could see on Friday it was up 6%. Now, be careful with any of these contras because the market over time goes up. So these over time go down. But for short-term moves, not as investments, but rather as trading vehicles, these can be useful tools in your thing. Now, is the move done? It's very possible it's done. And if the Dow turns around, I might be looking at, well, here's the dog. So I might want to look at buying the Dow instead of shorting the Dow if I think it's turned around. But if the market continues to sell off and I want to play Dow to the downside, DXG or DOG. DOG has 700,000 shares a day. DXD has 1.4 million. Let's say I think the S&P is going down further. I can do the SDS, which is ultra short S&P 500, which was up 6% on Friday. Trades 10 million shares a day, highly optionable with tight premiums. Okay. If I think small stocks are going down, I could play TZA. As you could see, had two kahunas this week. Big move on Friday, was up 3.82%. The small stocks moving up is the TNA, and you could see it was down 3.64. We're probably in all of these about ready to flip to the bullish side, so be careful. The Qs traded down this week. Now I could play the ETF called QID, which went up, similarly was up 8.47%. If I think the Qs are going up, I want to be long. I play QLD, which looks like the Qs this week selling off. SPXL is a 3X on the S&P, down 9% on Friday. SPXS 3X to the short side was up 9.32%. So I use these ETFs to trade various indexes, leveraged and often with options as protection against moves in the market. Let me say it loudly. These are not investment quality. These are purely for a quick trade. All right, sorry about that. I got called away for a second. So if this market, so let's just back up and let's talk about what I think is the likely scenario. I'm going to be sitting on my hands probably at 9:30. If overnight the Chinese market has bottomed and moves up off of a bottom, then I think our futures will follow. And if that happens, then I'm going to be unloading my short ETFs, probably watching some price points on some of the major stocks we talked about, and I'm going to consider going into this market because I expect at some point this week when that happens that we'll have a pretty ferocious move to the upside. I also expect that move to be short-lived, which means I'm going to be very nimble, not get married to my positions, and be ready to put my protection back on and start to raise cash again. But I've got cash because I've been raising cash. So if I get a hammer, I get a reversal day, kahunas on the major moving averages, I'm looking for that reversal day and a chance to play the market. Put up the spiders. All right, so again, here's the spiders. So what I'm looking for is a potential snapback rally up into this range in here, up to the 206, 208 range. That's 11 points on the spiders. It's about 5-6%. And I think we'll get it. The question is, I don't know if we're going to get it on Monday, on Tuesday, or Wednesday. And I don't know where it's going to look like when we start. So I'm going to be looking for one of those candles, like we've seen in the past, that suggest that we're done going down. Okay. Now, I'm also having a more bearish posture because I'm also saying that I'm very concerned that this support, as I have put in my title, may turn into resistance, and we may struggle to get above that. I don't expect us to go to new highs anytime soon. Stock of the day. Ugh, I hate to do this. I should say no chart of the day this week, but what fun would that be? So here's one I picked, and I'm not giving you bonds. Don't worry. Globant SA. Those who've been on my prior stocks of the day will say, gee, Jeff, it's the same pattern over and over and over again. And my answer to you is, of course it is. I trade the same pattern over and over again. So let's bring up the information. And let's take a look at what we got here. So, Globant closed. Notice the big up day on a horrible market day, up 4.6%. Now, of course, I should check the news and see what happened. Go to FinViz. Because if it was a takeover, we would change our mind. Earnings. Up on earnings. Up on earnings. Never a bad thing when stocks go up on earnings. So they had earnings earlier in the week. They must have gone up on Salesforce, Salesforce.com earnings. Okay? But their earnings are out as well. So the high of the day was $32.98. So let's say we're going to buy it. I want to be at least a nickel at $33.05. I'm going to put my stop at $28.50. Probably too much for comfort. That means I'm risking $4.55. So let me do some math here. Pull out my iPhone. Wish I had these when I went to school, huh? 33.05 minus 28.50 equals 4.55. Oh, that's too much. That's 13%. That's way too much. So let's look at other, bottom of this day, 30.25. All right, I'm going to go look at TradeStation for some more information. Just before I do that, let's point out some other things here. Mobo breakout from a squeeze. We had a PSA reversal on Friday. We're sitting right above the 50-day moving average, but we've moved up a little bit, which is why my stop's a little wider than I want it to be. Pocket pivots 2 days in a row, a kahuna, and the Phoenix is on the market as a whole. Bad market, no real news, probably up in sympathy to CRM, but a big move on Globant. Now let's go into TradeStation. And let's go into my screener. I know it was one of the stocks I looked at earlier. All right, so my last conditional change, those in the PUG group know how big of a deal it is at $30.82. And the low on this bar here, because I'll probably give myself a little bit more wiggle room. So low here was 30.55. The low here, 30.25. Low here, 30.60. And the high closed doji, the low was 29.33. Ugh. All right, I'm going to put my stop at $30.20. It's a tough one for me because this is such a big, tall day that's a 7% move or more on Friday. It's already extended from where it started the day. So any place I put my stop below that is going to start to get more than I'm comfortable with. So let's go back to the chart. So we're going to put a buy. Hold on a second. Chart of the week, $8.26.2015. So it's GLOB, buy stop at 33.05. Stop, sell stop at, what did I say? 30.05. All right. Risk equals 33. Risk is equal to $3. It's a big risk. A lot more than I usually do. But as I looked through patterns, this was about as good as it got. So I'm risking 3 into 33. That's about 10%. Much more than I'm happy with. Risk equals $2,000 per trade. Then I can buy 2,000 divided by 3 equals 606, say 650 shares. High risk trade. 1, markets. 2, markets. 3, I mean the risk is the markets, and then 4, higher stop than I want. Let's look at targets and where I'm going to go to break even. S1 is at 35.49. Excuse me, R1 is at 35.49. That's probably where I'm going to put my target. Equals 35, I'm going to say 45. Take off half. Move stop to break even at 33.05. And I have a second target because I don't expect this thing to just run and run and run. 39.17, which is R2. Take another half. Leave rest to run. Trail at 8% or chandelier. So what I've done is I've identified a stock pick I liked because it met my favorite criteria: uptrend, pullback to support, in a squeeze with multiple momentum indicators coming at the same time. It's in a PPS buy. It's been in a PPS buy since the high close doji day about a week ago on earnings. It's in a PPS weekly. My signals fired off, multiple OBVs heading up. I feel very good about the chart. I don't feel good about when I'm buying it. I should have bought it down here after the high close doji day, but it's the best that I saw. Let me look at a couple other charts very quickly. And again, I've been very conservative here. I don't like my stop. It's too much. So I'm putting 10% at risk. I'm only buying 650 shares. My risk on this is the market. Higher stop than I want. Higher at risk in stop that I want. I'm going to look to head at 35.50, which is, or 35.45, which is where resistance 1 comes in, take off half, and move my stop to break even. At 39.17, if I'm lucky and get there, I'm going to take another half off, so I'll be left only a quarter of my original position, and I'll let that run with a trailing stop or a chandelier. That's how I'm going to handle my chart of the week on 8/26/2015. These were my candidates. Beat is a cardiac monitoring company. They changed their name to something about monitoring. What do they call themselves? Well, doesn't really matter, does it? It's fundamental. Big uptrend, high close doji on the weekly, but in an uptrend it's mitigated. OBV is great. It looks great. It just doesn't look like it's giving me a pullback buy point. BIS, I should have made this my stock of the week last week. 1, 2, 3, 4, 5. But I've got a buy signal on the daily after a high close doji. Big move up on Friday. It's getting extended already. Buy close on a weekly. This is why you don't own these things as investments. It used, if you, with all the splits in 2012, it was $1,000. It's had a number of reverse splits. It's had a big move. And I'll ride this move until I get stopped out. I'm in BIS. Brocade we looked at earlier. Brocade has a doji kind of today, a buy on the daily and weekly, a high close on the weekly. It did come down from the high of the day. Does have a lot of buy signals. This is not unreasonable either. FAZ is an ultra short on finance. You could see, I showed you Bank of America and its brothers. Well, if they're getting hit, then what happens to a ultra short on finances? And you can see FAZ had a buy signal on weekly and a high close doji, a buy signal on daily Thursday. My signals are green, and this thing is taking off. We looked at SDS. You could see high close doji on the weekly and a buy, daily buy. Time to buy was probably Thursday morning on this. And La Jolla Pharmaceuticals, another nice looking chart. Let's go look at an HGSI. Buy signal on person, but sell signal weekly. That was why I didn't pick that. LPJC. LJPC. And you could see uptrend, pull back to the 50, a belt hold candle on Friday at the PSA reversal, mobile breakup from a squeeze and a kahuna. A lot to like on this chart. I just didn't like the weekly as much, being in a weekly sell signal. So this has been sort of all over the place today, so let me do some summarizing. Hold on 1 second. Here is the S&P 500. It is very difficult to look at this chart and be bullish. That said, so many of my indicators, whether it was the VIX spike, the percent of stocks below 200, below the 40, all of which are getting to areas that the market usually bounces. You don't often see a move in 1 week in the Dow of down 5.77%. There are many reasons to expect that we are getting close to where we expect to bounce. Okay? This is the correction that I am most interested in. I am most interested in because that's the worst one in this bull run that we've had. From top to bottom, 22, 23%. From top to bottom, we are at 7.4% on the weekly. If we're going to have a similar correction, we still got a long ways to go. Notice I call that a correction. That was not a bear market. This was a bear market. And that was a 58% move. So, early innings of the bear, late innings of the bull, we've had a huge move down. We are due a snapback. If we go back to 2011, that move ended with a day like this here, where we traded much lower and closed near the high of the day. Had you set your buy signal to be when you take out that high, you'd have played in the up, you hit support, you came back down. That was early in August. Here's another bigger move down, similar pattern. We opened here, we traded lower in the day, and we closed near the top of the prior day, and that was the reversal that led to a big move up. The characteristics of trading lower and then closing up on the day is what I'm looking for as a reversal signal. A hammer is often the ultimate reversal signal, where we opened, traded down, closed up on the day, and we're in a very narrow range between the open and close. That would be a great signal as a reversal. This is not a reversal signal. This is a reversal getting close. So I'm looking for that reversal. I don't know if it occurs Sunday night in the futures, Monday, Tuesday, Wednesday, Thursday, Friday. Maybe we lose 7% again on the week. I highly doubt that. But when I see that reversal signal, I'm also going to be cognizant of the fact that if I go back out to the weekly, this has been support going back since 2012. It's possible to get above it and go on and take new highs. The bulls will love it. I'll make money. Awesome. One of these times, and this could be it, it might not be it, we're going to get resistance and we're going to take out lower lows. I've heard all kinds of targets. I've heard targets about 1910. What is this? Oh, that's 1890. Kind of where the low, where we held up here. You might argue we're just going to hit this where we targeted earlier this year. We're kind of at that point. God forbid we visit the 11 and 2012 low at 1364. But I just hope we don't go down to the 200-day moving average either. These are all reasonable targets of expectation. My expectation is we end the week higher than we are right now, but I'm going to wait for the charts to show me a reversal, and then I'm going to address that and do my trades. Hope you have a great week. I babbled a lot today. I apologize for that. I think it's more important today to think about the market structure, what's underlying it, and be prepared when the market makes its move. But let the move happen. Don't anticipate. React to what happens. React to your charts. Have a great week. Bye, everybody.